Hello, my name is Sandra, and welcome to my channel From Lack to Legacy. On this channel, we're all things money, investing, mindset, mixed in with a little bit of travel, because you all know that's exactly what I do. If you are new here, welcome, welcome, welcome. Please don't forget, like, subscribe, share the channel. If you've been here before, you already know the drill. Go ahead, hit the like and subscribe button, share this channel with someone, particularly a Black woman or a sister who's interested in making money in the stock market. Even if you're new or a beginner, if you found your way here, then this is where you're supposed to be. And this channel is designed especially for new investors, new traders. So no question is a dumb question. I am still learning. I run a financial literacy learning community. We meet twice a month and we talk about stuff just like this. So yesterday I jumped on to share with you a new trading strategy. It's not a new trading strategy, it's new to me. I usually sell, hey chef, hey, welcome, welcome. I usually share or buy and sell naked calls and naked puts. That's how I learned to trade. That was the first thing I learned. I'm a long-term investor, along with I dabble in trading. It just kind of depends on where I am in the world. When I'm in the US, it's a lot easier because my schedule coincides with the schedule of the stock market. If I'm traveling and I'm abroad, sometimes it makes it a little hard to trade because the hours are so crazy. It's actually kind of flipped upside down. So when I'm abroad, I don't trade as much when I'm traveling, but when I'm settled in the US for a while, I love to get on and I love to share everything that I am learning. So if you are new to trading, new to investing, come on in, sit down, say hello in the chat. You know how we do. Okay. So what I wanted to share with you all today and what's up on the screen, these are covered calls that I have sold. And so this is in my paper money account, of course. So I am not doing this. I am not learning with new money. I would not suggest, hey, Z Tim, I know, girl, we on again. I got time on my hands. Got my grandbaby to school, got everybody breakfast started this morning. This morning I made bacon for my grandboy. And now his new thing is he's drinking coffee, y'all. So he drinks coffee. His mom is home today. So we all had he didn't have coffee this morning, but she and I had our coffee. I made some salmon croquettes. I be in here cooking, just so y'all know. Last night I made mini sweet potato pies. I got time. I got time today. So when I have time, it's nice to jump on and do a little live. So I want to update you all on what my covered calls are doing and how much money I have made with these covered calls. Not only that, I want to share some of the mistakes that I made because I made some doozies. I made some really simple rookie mistakes. And so let me back it up really quickly. We're talking about options trading, and there's a difference between investing and trading. And investing is generally a long-term kind of buy and hold. So if you're an investor, you might buy ETFs, you might buy, and ETFs are exchange traded funds, where you get a basket of stocks. You might buy an ETF like VOO, VTI, SPY, QQQ, any of those, and you hold on to it, for certainly a year or longer, and hopefully you will see the price go up, and that's how you make money on the sale because you sell them for more than you bought them for, and that's long-term investing, and we do that too. Hey, whoever's here, say hello. Stop in the chat, say hello. Don't forget, like, subscribe, and share. So that's long-term investing. But then the other part of what you can do if you're in the stock market and interested in learning how to make your money grow is you can trade. And so trading is more of a short-term kind of investment. Generally, positions are held for as little as 15 minutes, and you can even trade what are called leaps. And those are longer term options contracts, generally a year or longer. And so there's something for everybody. So today we're going to be talking about a particular trading strategy, not an investing. Well, it could be a way to generate income so that you can put that over into your long-term investments. So that's my strategy. But the strategy that we're talking about today, it's called covered calls. and we're selling these covered calls. And so let me back up. An options contract is just that. It's an agreement between two parties generally. And there's a buyer and there's a seller. And since we are selling covered calls, we are now the seller in this contract. On the other side of this is a buyer. So what are we selling? In a covered call, you have to own 100 shares of a stock. And you can see I have Apple, SoFi, Bank of America, Ford, and that T, the ticker T stands for AT&T. So if you're unfamiliar, the ticker for Ford is F, the ticker for AT&T is T, the ticker for Bank of America is BAC, the ticker for Apple is AAPL, and the ticker for SoFi is SOFI. So, in order to do this strategy, the first step is you have to buy and own 100 shares of each of those stocks. And so, since I'm in my paper money account, baby, and we rich in our paper money account, I bought 100 shares of each of those. And you can see Ford was the only one. I brought 1,500 shares of Ford because Ford is so affordable. And so let me go over here. I'm going to give you the current trading price. Child, we done made $243 so far on these covered calls. Now, I'll just say this before I go and give you the price of each one of those stocks. This is an income strategy. This is not where you're going to make $5,000. I'm not saying you can't, but this is a more conservative trading strategy. So you're not going to see the great big wins, but what you will see is steady income. So let me just get over here and tell you what the current trading price is. For SoFi, SoFi is currently trading at 18.96. Let me just put Apple in here. AAPL. Apple is currently trading at 261. AT&T is currently trading at 277. Ford is currently trading at 13.95. See, Bank of America is currently trading at 52.92. I think that's everything that we're working with in this practice portfolio. So Apple, Bank of America, AT&T, Ford, SoFi. Oh, and Pfizer. Let me go back and put Pfizer in there. PF. What is Pfizer? PFE. And Pfizer is currently trading at $26.46. So let me minimize this so you can see my screen again. And as you can see here, I purchased 100 shares of each one of these, and Ford is the only one that I purchased 1,500 shares of. These I purchased not today. These were purchased some time ago. When I bought Apple, I bought it for $261.54. I bought Bank of America for $52.87. I paid $29.06 for AT&T, $10.50 for Ford. I paid $20.56 for SoFi and $27.73 for Pfizer. And that will become important as we continue to talk about this strategy. You always want to know what you paid for the stock. So let me get back over here. Okay. So to begin this covered call strategy, you buy 100 shares of each stock. When you get ready to sell that, you are entering into a contract with a buyer. And so what you're actually selling is time. You own the shares, 100 shares, and you are going to select an expiration date when you get ready to sell it. So how long do you want to tie up your stocks? Because once you sell them, you can't do anything with it. Once you sell this covered call, you are in a contract. You are in essence renting out your stocks. And I'm picking expiration dates that are around 30 days. So the agreement is this: I, as the seller, am selling to a buyer time. You have the use of my 100 shares for 30 days. And because we're selling covered calls, we buy or sell calls when we expect the price to go up. And if you're new to investing and trading, you would do the opposite. If you expected the price to go down, then that would be a put. But we're selling covered calls. So here's what's happening. I am selling to an unknown buyer time, 30 days, and that buyer is expecting or theorizing that the price of the stock that they are buying from me or leasing from me for 30 days is going to go up. Well, not only when I get ready to sell this covered call do I pick an expiration date, I pick what is called a strike price. And the strike or strike price is a price for me as the seller. I am theorizing that the price is going to go up, but it won't go up as high as my strike price. So, as a seller, I do have a bullish position or theory, meaning I think the price is going to go up. In matter of fact, I'm hoping it goes up because when the price goes up, I make money really two ways. I make money on the stock because I still own that stock. I'm just renting it out for a little while, but I'm hoping that the price goes up, but not skyrocketing. Now, the buyer on the other end is also theorizing that the price is going to go up, but their theory, in essence, is that it is going to exceed the strike price. Because once it exceeds the strike price, all of that becomes profit for the buyer of this covered call options of this options contract. So there are two sides of an options contract. There's a buyer and a seller. And today our position is we're going to be sellers. We are selling a call, and it's called a covered call because we own 100 shares of the stock. And if by chance this stock price goes above the chosen strike price, the price that we are theorizing it won't get that high. If by chance it does get that high and exceeds that, something happens. We could be what they call assigned. And assigned simply means that the buyer of this call contract has the right to say, okay, I want to buy those shares from you at that strike price. And remember, if the price of the stock goes higher than the strike, they get to capture all of those gains above that strike price. So that's what's in it for them. I got to make sure I'm plugged in. Hold on, y'all, because my thing is going to die. Hold tight, hold tight. I got to get some juice. I don't know why I'm not juiced up. What's going on? Hold on, let's see. Did I? Okay, there we go. All right, there we go. Okay, last thing I need is for us to get cut off. I thought I was charging. Okay, I'm charging now. Okay, so again, an options contract is a contract between two parties. There's a buyer and a seller. Since we're selling covered calls, we are the sellers for the day. Somebody on the other end is going to be the buyer, and we're both hoping that the stock goes up. I am hoping that it doesn't exceed the strike price, and the buyer of this contract is hoping that it does exceed, or that not even hoping, but that is their theory, that the price is going to appreciate above the strike price. Because if I sell my stocks to them at the strike price, they get to capture anything above that strike price. And I think I went over why it's called a covered call, because I don't have to come up with that money if that happens. It is covered by the stock that I own. The stock acts as collateral. So I don't have to come out of my pocket at the conclusion of this contract, or if this contract is ever assigned, meaning I have to make good on that promise to sell at that strike price. So that was a mouthful. But when I tell you this is a high probability, low stress kind of trade, if you keep in mind a few things. Here are two things that I think are essential if you're going to sell covered calls. One, of course, you have to know your cost basis. You have to always know what you paid for the stock. Because, of course, if you're going to pick a strike price, You don't want to sell it for less than you bought it for. You would be selling at a loss. You don't even want to sell it for exactly what you paid for it. So for me, I try to always pick a strike price. When I get ready to pick a contract, I want a strike price that is above what I paid. Because in the not even the worst case scenario, but if in one scenario, this price of whatever stock it is, if it reaches that strike price, I've got to sell if the buyer, on the other end of this contract says, well, hey, we had an agreement. You would sell me your shares at this strike price. So it's important that your strike price is above what you initially paid for it. So you will get the gain there. Also, when you execute the sale of a covered call, you will get what is called a premium, because the person who is buying this covered call or buying this call contract from you, they have to pay you for the privilege of holding on to your stocks for whatever time frame. So I like to do roughly a 30-day expiration date. So if they're going to have access to my stocks for 30 days, they have to pay you for the privilege. And what they pay you is paid up front. It is yours. You keep it no matter what. If you let the contract go all the way to expiration, the 30 days, if you just let the deal play itself out, that premium is in total is yours. No matter what, you get to keep it. So you can make money two ways. So here's my best hope when I get ready to sell a covered call, that I pick a strike price that is above what I paid for the stock. So that in any eventuality, if I have to sell, if I get assigned, then at least I make a profit on those 100 shares. Because again, I'm going to agree to sell at the strike price. And I also get to keep the premium. So it's a double win. And let's go ahead and take a peek. I'll show you exactly what I'm talking about. And I can show you the mistake I made. Okay, so let's take a peek at Apple. So here's Apple. I paid $261.54 for Apple. I hope you can see that. Well, when I sold this covered call, I picked a strike price of $275. And what that means is if Apple should reach or exceed $275, here's my expiration date, by March 20th, 2026, I am agreeing to sell 100 shares of my Apple stock at this price. I don't want to sell them because I want to keep my Apple stocks, because I want to sell covered calls until I can't sell anymore. I want to keep selling them over and over and over again. But if I do have to sell them, then look, I only paid, let's just use some rough numbers. I only paid $260 for each of these. I paid $26,000 in essence. But what I would be getting back is $27,000. So do you see that? I would make roughly $15 on each share. I would make about $1,500, even if I had to sell them. So I am certainly hoping that by March 20th, 2026, the price of Apple stock stays under 275. I want it to go up a little because of course I own the stock. I bought it at 261. I want it to go up. I want to make money on my stock that I own, but I don't want it to go above 275. If it does go above 275, the person who purchased this contract from me, they're going to buy it at 275. But if the price went up to 280, they're going to be able to collect that extra $5 times 100 above this price, if that makes sense. Okay. So I sold one covered call, and you can see right over here, I'll show you, it says trade price. I got paid because options contracts are always sold in bundles of 100. I multiplied this by 100. I got paid $3.25 for each share, but we multiplied this by 100. So when I executed this trade and sold this covered call, They deposited $325 into my account immediately. If I do nothing but sit for the next 30 days, I get to keep this entire $325. So, what I've earned so far, what the contract, if I wanted to end it today, I would end it. If I wanted to close it out, I would end it. You see, this figure keeps changing. I could close it out today without waiting the entire 30 days. And I would take this $91 here, about 27, 28% of that 325. So you don't have to wait for the entire 30 days. I could close this out right now. I would just buy this contract right back and I could make off with the little $90. I just bought it yesterday. If I'm not mistaken, I bought it yesterday. Let me see if I could tell when. Okay, let's see. Let me hit it. It came up just a second ago. When did I buy this? It popped up. Let's see. You have to hit this thing just the right way. Anyway, I think I bought it yesterday. I think I did. I think I bought it live when we were on the. There it was. It just popped up for a second. Okay. Yeah. I purchased it on the 19th at 10:38. And since yesterday, this contract has earned $91. I could close it out. Somebody asked me on the live yesterday, can you make $100 a day selling covered calls? Yeah, if you got Apple, if you got 100 shares of Apple, but do you see how much it costs? Now, if you got $26,000 and you can go out tomorrow and buy 100 shares of Apple, you can make $100 a day on covered calls, selling covered calls. Is it conceivable? Yes, it's possible. Is that always going to be the case? Of course not. There are no guarantees in the stock market. You just have to be smart about how you enter, picking the right strike, picking the right expiration date. All of those things go into picking a good contract. What else was I going to say about that? So my goal now in life is to own 100 shares of Apple. My daughter and I were talking about this last night, honey. That is the goal, is to just purchase 100 shares of Apple because those contracts pay a beautiful premium. Something a little more realistic might be, say, these Ford contracts, because Ford is currently trading it's under $15 for sure. Let me see again. I'll tell you the exact price. Ford is trading at $13.91. And so for Ford, I picked a strike price of $14.85. All I need is for Ford's price to stay under $14.85. It shouldn't exceed it. I don't want it to exceed $14.85 before March 20th. And I sold 5 of these covered calls, and they gave me $140. They deposited that into my account. So we have made approximately $750. You can see that's a far cry from the money you can make on Apple. But we opened these up yesterday as well. And so the same is true for SoFi. And here's the mistake I made. Can anybody see the mistake I made on SoFi? Here's SoFi. I picked a strike of 20. So I'm saying I hope the price does not exceed $20, because if it exceeds $20, I have agreed to sell my shares for $20. Well, remember, when I purchased my SoFi 100 shares, I paid $20.56. Because I picked a strike price of 20, I'm agreeing to sell them for $20. I would be losing $56 if the price of SoFi exceeds $20 and the buyer of this contract says, well, hey, you got to make good on it. You said you would sell me your shares for $20. I'm selling at a loss. I did not, this is what you don't want to do. You don't want to pick a strike that is lower than what you paid for your stock, because what you're saying, you are entering into an agreement that I will sell my stock to you at this strike price. And I don't know why I did it, but I did it. I wasn't paying attention. And so I got the premium. The premium was $89. And so far, if I wanted to close this out today, which might be smart, I would take 41, almost 50%, $41.50. And I could close it out safely. But the reason I haven't is because SoFi has really strong resistance at the $20 level. Every time it gets to near $20, it rejects. So another thing you will want to know when picking your strike price is, where is resistance? You know, where do these stocks hit a ceiling? And you'll be able to look at that. Let me get over here and see if anybody's in here. Hey, Nichelle, we back, girl. We back. I just wanted to share how those covered calls are coming. And so you can see, oh, wait a minute. Okay. I don't know what's going on over here, because a second ago we had some, oh, let me profit. Anyway, so we've made $75 on, or 72. You can see it's constantly changing. $70 on the AT&T. We made $7.50 on Ford, 42 on SoFi. We've made $22 on these Pfizer contracts. This is what we have made so far. And so we could close them all out, really, and we would take home the 68, the 70, all of this. We would take all of this. This is our money. And then we would still get to retain all of our stocks, and we could just do it again. So that's the beauty of selling covered calls, is that you can rinse and repeat. And so that's how it becomes an income strategy. So what would we take home today if we were to close these out? 70 and 70 is 140, plus another 40 is 180, plus 20, that's 200. We would take home about 250 if we were to close all of these out today. And, you know, that's not bad. But if I hold them all to expiration, you know, just let it play out. You could tie your stocks up, you know, until most of these contracts are out till March 20th. This SoFi is the only one that expires March 6th. We could collect the entire 325 potentially, as long as the strike price doesn't get exceeded, as long as Apple doesn't go above 275. And we're going to look at each one of these individually. So why would I pick a strike price of 275 for Apple? Let's go to the chart. And here's Apple. And the high, we saw Apple hit a high of 264. Let me put this on a daily chart, and I'll show you why I picked 275. I don't know why my thing is moving so slow. Okay. So Apple hasn't been above 275. Let's see. If you look here, I'm moving my, let's see, I'm going to move it to about 275. You can see Apple was above 275 once. It got up to 288 on this day, which was December 3rd, around December, the 1st of December, 2025. And it hasn't been above 275 since then. So I felt reasonably sure. And let me go ahead and blow this up so you can kind of see. So when I move this to 275, you know, it looks like there's a little resistance around, I'm gonna say around 280. Yeah, it looks like. And how do I see that? Let me go ahead and put this on my chart. I'm gonna do this. So I'm just gonna run this across. I don't know why this thing is skipping like this, but around 280. And all I'm doing is trying to get as many points in here as possible. So let's see, if I do go here, I want to go to the top of this candle, this big red rejection candle here. So at about 280. And so you can see, look, it went up to 280, bam, bounced back. It got approached 280, bam, bounced back. Got up to 280, 280, 280, bam, right back down. So maybe even a strike price of 280, but I figured 275 kind of balanced out the premium that I would receive along with the chance. Hey, Elle. Hey, it's so good to see you. So I picked a strike price of 275 because the premium was really good. I think again it was like $325. But another thing that I look at when I'm selecting the strike price, I'm going to go over to, so I looked at resistance. Where's resistance? Where is it likely to reject? And not by that, I mean not go above. I miss you too, girl. It's so good to be back talking trader talk. Oh my God. So, we learned a new strategy. I'm sure y'all already know this. The advanced traders in the bunch, they already know this. It takes me some time. So we're talking about covered calls today. So this is my new obsession is selling covered calls. And so we're talking about selling covered calls with Apple stock. I like Apple because it's liquid. By liquid, I mean there are lots of people trading it every day. It gets good volume. The bid ask spread is really tight, meaning you're not going to lose money on slippage. I know these are some words. We'll keep going over it. But the bid ask spread is nice and tight. The premiums are nice and juicy. You can make money trading and selling Apple calls. The only drawback to Apple is that it's a pricey stock. It's over $250 a share. So, it's 260 some dollars a share. So you've got to have a sizable amount if you want to just jump in and get started. But some of you are sitting on stocks, 100 shares of stocks, either in your retirement accounts or investment accounts. And if you didn't know, you could actually be selling covered calls if you are already in possession of 100 shares of stock. I had no clue. Had I known that, I probably would have approached my long-term investing a little bit differently. I have a very diversified portfolio, which is kind of heavy in ETFs. Well, my approach now would have been to focus on acquiring 100 shares of a stock that lends itself to trade or selling covered calls. I would have maybe balanced that out a little bit more. And so I may still sell some of my shares that I have in ETFs to fund my quest to own 100 shares of Apple because I'm going for it. I'm telling y'all, I'm going for it. Those Apple premiums are just way too juicy to not make this little money every day. It's easy to do. So here are the things that I look at when I'm choosing a strike price for when I'm ready to sell a covered call. I'm looking for resistance. Where does this stock price have trouble getting above? That's going to influence my decision. That's one thing. Let's get over and look at the options chain because there's some things there too. And we get to the options chain by hitting this trade button at the top. And so I'm going to go here and put the Apple ticker if I could get my thing to respond. Okay, so we're looking at Apple, and I picked this expiration date here. And remember, I bought these yesterday, so it's 28 days to expiration. But when I bought it, it was 29 days to expiration. So that's about a month out. And on the left-hand side of our options chain, you'll see the calls, of course, because we're selling covered calls. If you look right down the middle, you'll see the strike price. And again, remember, the strike price is the price that we agree to sell our stock at if, the price should get that high. So I picked a strike price of 275 because I just don't think that it's going to get to 275 very easily before this expiration date of March 26th. And I also picked it because the premium was nice. And not only was the premium nice, but more importantly, I looked at my delta. And this delta in this case is not a predictor, but it does give you some insight into the likelihood or the probability of this contract expiring in the money. Or is it out of the money? At any rate, I have a 27% chance of this strike price, of the price of Apple getting to $275. This is what you want. You don't want, you know, think about it. There's a 96% chance that it will hit the $220 at the end of the Well, of course, there's a 96% chance that it'll be at 220. It's already at 262. So you would never want this. Although look at the premium that you would get, but you would certainly be assigned. Who wouldn't want to buy your Apple stock at 220 when it's worth 262 today? So this becomes, for me, you could have chosen maybe the 280 strike, because that really is where our resistance is. But I wanted to kind of amp it up a little bit, get a bit more premium. Here's the price right here between these two is, I like to choose the mark for my price because it's like right smack dab in the middle. So 270 or $159 is what you would receive as premium. And that's the money that goes into your account the minute that you execute and the minute that you sell this covered call. And then the delta is almost like, it tells you there's an 18% chance that it will reach this 280 strike price. That's a pretty good odds in our favor. If I wanted to make even more, I could have gone with the strike of 270. That's a little too close for me, but it was certainly doable. It hasn't gone anywhere near 270. And there's a 37% chance that it would get to the 270. So anything under 30% to me, any delta under 30 would be one that would be attractive to me. So I'm going to look at, where does the stock price hit resistance? Because that resistance is telling me it's a good chance it's not going to get above that price. I'm going to also come over here and look at my delta just to kind of confirm that, oh yeah, there's a, this is the likelihood of it reaching this strike price. Okay. So those are two things that I'm going to look at when I'm trying to determine the strike price. And then I just like a 30-day expiration, because I can sell that covered call with the 30-day expiration. I can always close it out. And if we sell it to open up the contract, we have to buy it back to close it. And so just for demonstration's sake, I am going to close out one of these covered calls. Let's go back over and see what kind of money we're making. This one is at 47%. The Pfizer contract, we were paid $46. We've already made $22. So it's almost 50%. We could close this out today, collect the $22, and then go turn right back around and sell another covered call. So why would you tie up your stock for all the way till March just to make another $22? When we made these $22, man, I wish they could tell me when I open this contract. Usually when I click on this, I want to create a closing order. This thing's a little glitchy today. My whole internet setup has been a little glitchy, but I could collect this $22, sell another cover call. So let's go ahead and buy back this Pfizer. We'll take half of the profit. They put $46 in my account. I'm going to say, well, I'm not going to wait. I'll just take this 22. That's like 47%, almost half of what the premium was. And they'll deduct the difference between what they put in yesterday. I'll get to keep 22 of it. They'll take about $24 back out, but I get to keep the 22, and then I get to sell this again. So we can do it right from here. If you come all the way over to the right, there's this there are 3 lines and 3 dots. we're going to create a closing order. And if you noticed when we did it yesterday, if you're selling, that line will come up red. When we're buying, it should come up green. So let's go ahead and tap it. And I just want to see that you all can see what I'm doing here. Okay. So did you see? It says single buy one contract. It's the Pfizer. I'm just going to double check. It's the 28 strike. Yep, that's what we had. And this is the expiration date. And now it's going to cost 25. Let's see. Do I want to pay 25? I'm going to move it over here to the 24. Let's see if I can sell it for 20 or buy it for 24. That's just, you can play with it. That's the midpoint, 24. The mark is 24. I'm going to ask if I can, buy it back for 24 and I can keep a few more dollars. I'm going to hit confirm and send. And I need to share this dialog box with you all. Hold tight. Let me stop sharing. Share. I'll show you what the dialog box looks like. This is your order confirmation. Okay, so it says I'm going to buy one Pfizer contract. That's all the information. And I'm going to be paying $24.65 to buy that back, which means of the $46 they gave me, I'm going to be giving 25 back. So let's hit send and we'll see if we can close this out today. Let's see what happens. You'll know because you'll see that little blue box pop up in the upper left-hand corner and it'll go ding. So let's hope we can get out of this pretty quickly. Yeah. And so that's it. So you've seen me. Well, let's see. What do I have here that I haven't bought? Close apps before scheduled update. Move out the way. We've got Apple. Oh, we don't have Bank of America. We could sell covered call on Bank of America just so that you can see how it goes. And I'm going to roll over here to this and see what's working. I've got a working order. Oh, that's Apple. Let me go back over here. Okay, so I do own 100 shares of Bank of America, and I'm just going to do a little bit of work. I'm going to look at Bank of America's chart and see what would be a good strike. BAC. And again, I'm going to be looking at this, trying to see if there is a clear place for resistance, and that's going to help me pick my strike price. So let me do this. I'm going to highlight this. I'm on my daily chart. And I'm just going to look at the recent history of Bank of America. And then I'm going to plot out. The high was 57.55. So let me 57. I like to put that line so I can see it. Okay, so we just sold or we bought back those Pfizers. So I'll go back over later and see what we actually made on that. So in recent history, January the 5th, 2026, Bank of America hit a high of $57.55. And then more recently than that, it hit around 56, about the same thing. So I could say that there, just roughly looking at it, it's been some recent resistance at around $57. That's one piece of information. So now I'm going to go over here and look at my options chain for Bank of America. I like a strike price that is 30 days out, roughly. So again, I'm going to go with this March 20th expiration. And I'm going to come down on the call side and look at the strike at 57.50 and what it would pay. Or I'm going to look at these two because this one has a delta of 0.10, 0.10. This one has a delta of 0.26. I like this delta a little better, but that's a little close. That's saying a strike price of $55. Well, I don't know. 52. It said 52. How likely is it to get to 55? I'll tell you something else I look at too when I'm trying to decide. I also like to look at the ATR, and that's the average trading range. So the ATR for Bank of America is $1.32, meaning it on average can go up $1.32 a day or go down $1.32 a day. That's helpful to know. It's not one of those that races up the chart. Let's see, let's say $1.50 more would be 23.20 would be 53, 54. If we picked 55, I would feel okay with a 55 strike. Now I'm going to look at what I paid for Bank of America. Let me go back over here. What did I pay for it? I paid 52.87. So if I agree to a strike of $55, I'm making roughly $2.13 a share. If I have to sell, I'm okay with all of this. So let me go back over here, and we're going to sell the 55 strike of Bank of America. And so here's the premium. We would be getting roughly $53. Yeah. So I'm going to hit right here at the bid, and you'll see that little word that says sell. And when I hit it, we're going to sell this 55 strike. So sell, and then I hit single up top, and here's the order. Now, this is where I made a mistake before. You see this automatically pops to 10. We don't want to sell 10. We only want to sell one. I only own 100 shares. So each contract is for 100 shares. So I'm going to go ahead and change that to a 1. So I'm selling one contract of Bank of America with an expiration date of March 20th, which is about, roughly a month out at the 55 strike. It's a call. And right now there's nothing. It's 53. I don't have too much wiggle room. So let's go ahead and sell this one. Confirm and send. Let me show you the order confirmation box came up. Hey, yes, I'm going to see you in a little bit, sis. Okay, so let me share my screen. Share the screen. Order confirmation box. And there you have it. So we're selling this one. The max profit is $53. And so what they're going to credit to my account is $52.35, because of course we pay 65 cents for each contract. So they're going to give me $52.35. So I'm going to send it. And as soon as I send it and the order goes through, they will put that $53 into my account. And there you have it. It just did it. So we just sold that covered call. And let's go over here and see. So it popped up right here. And so far, it's already made 50 cents of that 54 or $1. If we wanted to, we could cash it out right now, take our $1 and be done. But that wouldn't make much sense. So let me get over here, and I want to show you where they credited right to my account. You can see it right here. These are the contracts or the things that we executed today. At 10:02, we bought back that Pfizer, remember? And they took the $24 out of my account. Initially, I think they had put $44 in there, so we made $20 on that. Then we just sold this Bank of America, and they deposited $54 into my account. If we leave it to expiration, we get the full 54. So that's how you can make money selling covered calls. I'm telling you, it's just I'm enamored with it. They got me. So my whole goal in life is to start making sure that I have 100 shares of, stocks that lend themselves to selling covered calls. And so do your own research. Do your own research. The ones that I like SoFi. It's a little volatile. I like Ford because it's very calm, but the premiums are pretty low. Um, Apple is like, for me, it's the brass ring. If you can own, or if you own 100 shares, whether it's in your personal brokerage account or if you have it in your retirement account that you have control over, y'all learn to sell covered calls. I would not steer you wrong. So on that note, I got to get going because me and my sister Mara Love, we got an appointment today. We're gonna catch up. We haven't talked in a while, like in person. And so I'm getting off of here. The analysis is short and it's more long term. Yeah. Listen, get cell cover calls. Are you gonna make $1 million? No, you are not. I'm telling you right here, right now. So if you are thrilled when you can, buy a contract, options contract, or set up a trade and you make $400, this might not be the strategy for you because it's, it's not exciting like that. It's not fast money, but it could be daily money. It could be daily money. It could be weekly money. It could certainly be monthly if you don't even want to fool with it, for people who work and say you don't have time to sit in front of your screen watching a trade and being anxious and setting, you know, your stop loss and take profit, all that stuff. You don't want to fool with that. Sell your cover call. Walk away. You made the premium. You don't have to watch it. The premium is yours to keep. You could spend the money if you don't mind letting that contract go on for 30 days. And if you don't mind the and I say it's the worst case scenario, but it doesn't have to be a worst case scenario. If you don't mind, say on the off chance that the strike price that you selected, the price of the stock exceeds it, and you get assigned and they sell your stock, you're selling them at a profit if you did it right, if you set it up right. So you profit from the sale of the stock at the end of the 30 days, and you get to keep the premium. Child, they should have been told me this. I could have been doing this. But you know what they say, when the student is ready, the teacher will appear. And so I guess now is my time. But I wanted to ask CTEM too, because CTEM is here. CTEM trades credit spreads. And they try to teach me this. First of all, y'all already know I made no bones about it. This brain of mine is a 65-year-old brain. It's a 60-year-old brain. And it takes me a while. But it feels like this is part of what CTEM was trying to teach me. This feels like one leg of credit spreads. I feel like in the credit spread, you sell something and you buy something. You kind of box yourself in because you're saying, I know you're picking a strike at the top where you don't think the price will exceed. And then you're picking another strike at the bottom where you think it won't go lower than. But child, when I tell you they were trying to tell me this and explain it to me, it was too many things going on. But I do understand this part at the top, like picking a strike where you don't think the price of the stock will exceed. So I'm gonna go back in one more time and try to learn how to do credit spreads. And I guess this is just how it goes, y'all. You do what you can when you can. So hopefully this helps somebody. I hope this encourages you. If nothing else, start building out a position of 100 shares of a stock. And then once that's the first step. Do that. And we will be back hopefully with, yeah, see, Tim said one piece at a time. Yes, ma'am. One piece at a time. And if you're like me and you feel overwhelmed, don't worry. It'll click. Just keep trying, keep working in your paper money accounts. And I promise you the light bulb will go on. On that note, I gotta go. I gotta go talk to Mara Love. I'll talk to y'all later. Thanks, everybody. Don't forget, like, subscribe, share the channel, and we'll be back hopefully tomorrow. We'll buy and sell. We'll sell another covered call because I have some things opened up, and then we'll buy some things back, and we'll look at our profit and how we're going. All right, y'all. I gotta go.